I set out with Bouqs, I was like, we're never going to sell vases. Vases make no sense. Everybody has 25 vases in their homes. They take up space. No one ever uses them. Why would I send a vase? And every day when we didn't sell vases, customers just said, please sell vases, please sell vases, please sell vases. And I was like, look, let's just turn on vases. No one's going to buy them. And it was all of a sudden like a 34, 39% take rate. It was the highest margin product we ever had. And it was like, all right, we're going to have vases.
Welcome back to another episode of VC Unfiltered. Super excited to have John Tabis today from M13 Venture Studio. John has been a staple in the ecosystem for ages. He is one of the most thoughtful early stage entrepreneurs that I know of. Before jumping into venture, John ran the Bouqs company, and he actually came and presented to my grad class almost a decade ago now. And so I'm thrilled to welcome John to the show. John, welcome to the show.
Glad to be here.
You joined M13, a couple years ago now? Walk me through more about the venture studio piece and kind of what you guys are doing over there.
The studio has been around since the beginning of the firm, and joined to really explore what a venture studio model could look like inside of a fund. And it's a pretty unique setup, right? Not a lot of firms have this incubation and writing checks and writing pretty sizable checks. Like the core fund at M13 writes, $6 to $10 million lead checks into Series A businesses, where we're building companies with, a couple $100,000 a pop. And so it's an interesting experiment, and one where the venture studio side kind of went through a couple different iterations before I joined. It was a partnership with Procter & Gamble to start, did something similar with Pepsi as a follow-up, and then became sort of like a Techstars sort of model, right? Cohort-based, multiple pods of curriculum, et cetera. And now we're really building based on sort of big problems that we identify in the world where we think software can solve. And we do it in a pretty unique way, I think, which is we build the companies on paper to start. We do market research and we learn about them, and then we talk with experts in the space and we learn more that way. And then we build a deck and we sort of outline what the company would look like if it were to exist. And we share that with experts in the space and operators and folks that used to work at a competitor or at a related space, whatever it might be. And we do all these things along the way. We test and learn, but we're doing it because we have to do the work, which matters. You have to know these things to build a business, but we're really doing it as sort of an experiment. Like, can this work create gravity? Can it draw in people and resources so that we can actually make this thing real? And if we do the work and it's great work, but no one ever shows up to work on it, no one says, hey, can I invest in it? Or, hey, can I be on the board? Or, hey, can I run it?
Yeah.
Then it's probably not really the best business to build, right? And this is sort of replicating what happens out in the wild anyway. You're going to start a company, start talking to some friends. They want to work on it too. You all get together, you start working on it, and it goes or it doesn't go. But without that sort of initial momentum, nothing really happens. And that's what we're trying to recreate in a more efficient way inside of the Petri dish that is the M13 Launchpad.
Awesome. So what does that ownership structure kind of look like, and what is that process like once you've kind of incubated them? Like, are you then bringing in the team? Like, what is those next couple steps end up looking like?
Yeah, we start companies in partnership with almost any profile you could imagine. It could be in partnership with a corporate partner, a celebrity, an individual, a team, a fully formed team or a partial team. We're not really too specific about it, right? Because great ideas and great insights can come from anywhere. And so it really is different depending on kind of, if you think about it as beginning inside of the Launchpad, where it's our idea, we work on it for a material period of time, and we therefore spend a lot of our own resources, versus something that might come from the outside where they already have a team, maybe they have some technology, but there's some gaps that they need filled, right? Yeah. And so depending on those two scenarios, the difference, a difference can exist in what the cap table, the ownership, and the incentives look like. But we are a studio that fully believes in the founder, and we are ultimately a founder-led model. We do not run companies. We do not build and launch companies without founders. We do that in partnership with teams that have coalesced around a concept and want to make it exist in the world. And so, regardless, the founding team, not the Launchpad, are going to own the vast majority of the equity, upwards of 70% of the equity when we kick off. We will write a check, typically $250,000 to $500,000, to give them, call it the pre-seed or the friends and family like funding that they need to get it started, to get it built, to get a team coalesced. Makes it a little bit easier, a little bit faster to get to market, and hopefully with higher quality and therefore a better shot on goal. But the check is a portion of the program, but it's sort of not the end of our engagement. We stay with the companies up to and until there's a seed round, or in case there is going to be one, to really be a resource and a set of assets for them, people, processes, ecosystem, to help them continue to build that company in the most efficient way possible.
So is that kind of the even the equity piece, is that kind of the differentiator? Because it's sounding more like the model's closer akin to like what Mike is doing at Science versus like some of the other venture studios that are out there, that because like a lot of the other venture studios that were taking like 50 or 60% of the equity to kick it off, or too large of a portion, had insane problems trying to raise those follow-on funds. And so is that kind of where you see the model actually working and getting that additional funding as they go through, or what are the other differentiators?
Yeah, I think one is, we don't, a lot of those folks, and I wouldn't claim that we're right and anyone's wrong, but just differences. A lot of those folks tend to have a very specific type of business that they build, right? We're going to build uh, SaaS for vertical industries or whatever it might be, and that we're going to do that every day, all day, because we're going to get really good at flexing this muscle. And then their primary value add is that they hire the engineers and the product people, and they spend a ton of money to build those things. And that does move a company from zero to something pretty quickly. The challenges with that is, as you mentioned, because you spend so much money, you have to take a ton of the equity to have the math make sense for you. And that seems to, in the market, lead to some problems with follow-on financing, because the founders get, smashed down through dilution, and pretty soon they own a sliver. And then it's sort of like, well, how do we make sure that the talent that's here stays here
Yeah.
over time? And there's creative ways to solve for that at the time. But we don't solve that way for two main purposes. One is, as you said, it can be demotivating for the rest of the market to follow on invest. We also don't see that the sort of shared services, if you will, as being the real differentiator. That's basically just money, right? And then also, in some ways, we feel like it's antithetical to the founder sort of figure it out mentality. If we build it this way and the founder would have built it this way, and then we put the founder on top of this, we're now sort of handicapping them by having them working inside of a set of technology, a set of processes, a go-to-market strategy, or whatever it might be, that is different than what they would have done. So instead of them feeling like they're in the flow, they're rocking and rolling, they're making it happen, they're kind of dancing around some structure that they wouldn't have chosen. And so between the sort of the motivation around common equity and ownership structure, around being able to just spend the money on your own product people and technology people that you want to hire once we write the check and attract other capital, and then this sort of having tailwinds at your back instead of headwinds, based on what was already built. We feel like we want to be lighter touch from a building perspective, but a whole lot of guidance. Here's some great people to build with. Here's an expert in AI that can help you think about how to integrate AI into this business. Here's a go-to-market team that can help you get it launched, right? So we're helping them move faster, more efficiently, but not necessarily dictating the direction they go.
I like that approach, and it seems like it might help solve some of those other challenges that are definitely out there. Super interesting. So let's switch gears a little bit. I know that you came into to one of my grad classes probably a decade ago now when you were at the Bouqs, and gave one of the better talks that we had actually had from speakers throughout that time. So I kind of just wanted to dive through a little bit of some of the high level learnings that you came away with from Bouqs, things that worked, maybe things that didn't, and just kind of see what played out.
Yeah, I mean, great journey with Bouqs. Still chairman of the board there. Love the product, love the team. Has a really great chance to still be a very massive brand in what is still fundamentally a pretty broken ecosystem. Although we've done a good job of pushing that industry in a better direction, which I think we're all really proud of. But yeah, I mean, it was a heck of a journey, right? I ran it as CEO for almost 9 years. Chairman of the board now, creeping up on 5 years, and it's been a really great journey. I think the probably the biggest things that I learned along the way are a few. I think one is every technology business, whether you think technology is the thing or not, is a technology business. There's no allowing the technology to be sort of okay or second fiddle to anything else. It has to be a core competency nowadays. If not, you will spend way too much time and way too much money trying to fix your underinvestment. And that happened to us. I underinvested in the Bouqs infrastructure in the first 2 years. Had great talent that worked their butts off, but we just didn't build as robust of a stack as we needed to build. And come, call it 2016, maybe more like 2017, we were just too big for the platform we had built, and we had to rebuild it. And that was extremely painful. We went backwards for customers instead of forwards. It took millions of dollars, a lot of time, a lot of distraction just to sort of get back to where we were already, 2 or 3 years prior when it all wrapped up. And that's hard for a lot of reasons, right? It disappoints your customers because they're losing functionality they had before. And your argument to anyone is like, well, we have to do it. It has to work, and it has to work at scale. But a customer that's been with you for 3 years and it's worked great doesn't care, right? They don't care about your scaling problems, and rightfully so. They're not experiencing those issues. So that was definitely one, which is, especially now with the advent of AI and all that it means, being a software business, an online business, a digital business, there's no getting away from being a technology business. You have to be. So that's one, I think, that I learned pretty clearly, pretty early. Second one was more about building the company, not building the product, which to me always seemed like it was going to be the easy part. It felt like the technology and the product building and product market fit and marketing and all that stuff would really be the hard stuff. And I was totally wrong. That part, man, we grew fast in revenue, faster than we ever could have imagined. Users were happy. That part worked. The really hard work was building a company that could scale with it, right? Getting people operations right, getting management right, getting leadership right. That was all really tough. Also, just a complete blind spot for me where, the biggest team I had run before I started Bouqs was three. And those three were at the Walt Disney Company in corporate strategy, where everyone came out of Wharton, Stanford, and UCLA Anderson. And I didn't really manage them so much to say, wow, that was amazing work. Here's another thing to do. Go do it better than I would do it. And that was our dynamic, right? Pretty different than when you're running a team of 50 and you have multiple functions and layers. And so I think that one, I underappreciated it, but two, I think I moved too slowly to enforce the culture that I really believed in. I was very much a newbie to this space, and in a lot of ways deferred to folks who had been in the startup space more than I had, and maybe to our own detriment, right? I'd gotten great advice from a mentor and a friend of mine named Jason Nazar, who's had multiple exits here in LA. And he said, look, if someone's neutral, they got to go. If someone's negative, they have to have been gone yesterday, because this will kill culture for you. And I genuinely just didn't believe him. I thought, man, you can't just fire anyone that's neutral. Like, neutral's not bad. And Jason was 100% totally right. Everyone that was neutral eventually left, just not with me firing them, but just they left of their own accord because it wasn't working for them. And so that lesson of like, if we're not all on board, and we're not all rowing actively in the same direction, then we're not on the same page, and that's not going to work out long term, was really a big lesson, along the way. And I think the last part is like, sort of staying true to your guns and sticking to your vision, right? I had a very specific vision for how this business would look when it was all done. And there were times when we deviated from that path because of all the voices. You have investors, and you have advisors, and you have your team, and you have your employees, and you have, the press. And, early in the days in me pitching Bouqs, a lot of people told me, well, just build Uber for flowers. Because at the time, Uber for anything was super everywhere. That's just what the sort of model du jour was. And we're saying to the VCs at the time, like, that exists. That's every large incumbent you want. You go on a website, you order it, shows up the same day. Like, why is that innovative? But it was innovative because it was innovative, because Uber was innovative, right? And my response was always, the problem in flowers is not the last mile. The last mile works pretty well. It's the first 2,999 miles. It's broken. That's where all the waste is. That's where all the flowers go to die. That's where all the margin is taken. And that's the part we really want to fix. But that's a much more complex and much less obvious problem to solve. And it didn't have an Uber for in front of it. And so it just wasn't as easy to get across. So we stuck to our guns, and all the others that came in to do Uber for flowers utterly failed, and our tombstones on the investors' websites. And that's okay. Like, we could have been wrong. They could have been right. Yeah. But at the end of the day, like, following sort of the massive wave of stuff can be a good way to raise money, but it might put you in a tough position in terms of building a business that actually makes sense.
So that's a really good point. So, but I want to go back to that point that you made around the advice and the voices that you hear, because I think this is one of the tougher things for, especially in the early stage from an entrepreneur's perspective, is that we live very much in the wild, wild west, right? Like, there isn't necessarily there isn't a silver bullet or necessarily a right answer. And it could be different for each situation and for each person. So How do founders kind of go through that or what are those steps that they to be able to kind of sort through that actual advice that you'd be able to give?
Yeah, 100%. I mean, founders have to have extremely strongly held convictions, extremely loosely held. And that doesn't make a lot of sense, right? Everyone's heard strong convictions loosely held, but like it needs to be very, very strong until it really needs to not be, right? And it's a hard thing, and there is no science around it. It really is a gut feel thing. What I can say is you're going to get opinions from lots of places, but what you often don't get is why those opinions are what they are and the context behind them, right? So you will get an opinion from a venture capital. Let's just use an angel investor. An angel investor says this is the right time to sell the business. They might say that because they believe it's the right time for you to sell the business. Or it might be that they really need to get liquid in something. And they're saying that to every single one of their investments, right? Same thing with a VC, same thing with a private equity firm. Like anyone whose motivation is not necessarily purely your own, you are allies because you have a general alignment of incentives, but those aren't always the same for lots of reasons, right? And often things that have nothing to do with you or your company. But as you and your relationship with that individual investor, advisor, mentor, employee, whatever it might be, partner, potential acquirer, while you see it through the lens of this business that you care about and it has this mission that you care about and you want to build, their lens is different because their job is not to run your company or to even necessarily maximize the value of your company. It's to maximize the value of their portfolio, their other investments, or their partnership with you, or their employment with you, or whatever it might be. And so I think founders often, and myself included in this, tend to sort of paint the world with a broad brush of, hey, we're all in this for the same reasons because these are noble reasons that I believe in, and this is why this company exists. And recognizing along the way that that's not necessarily the case. And that doesn't mean it's necessarily bad either. It's just the reality is really important. And so you don't close off and say, I know everything and I'm going to make every decision with no input. That's not a great path either. But you have to filter that input, filter that feedback, filter those remarks, those moves, those things that they may do through the lens of wherever they're coming from. And each player around you that works for you, next to you, or you work for is going to have their own lens on it. And just being cognizant of that before you sort of take the input or the direction at face value is really important.
I would agree with that. Hear everything, but push away the stuff that isn't useful and keep the stuff that is, but make sure to listen. Let's jump back to when you're looking at some of the portfolio companies that are coming through M13 or the ones that you might want to actually invest in. Like, what is some of that criteria of what you're looking for, especially because it's so early when they're just, I mean, it could be an idea, or most likely is an idea on the napkin, right? Like, what is it that you're evaluating or what gets you excited to want to write that check?
When folks come in from the outside or, we have an idea that we attract people to, the first is just what I was saying earlier, which is that momentum happening, which is a magical sort of non-definable thing, right? Hey, are we getting the momentum where people, resources are coming towards this? And that's a very subjective thing, but it sort of sits at the top of everything. If we're seeing that happening, we're feeling good. If we're not seeing it happening, we're not feeling good. But other than that, we're trying to fill sort of 4 core buckets in any given concept or exploration, right? We need to fill it in a team. We need to feel great about the founder, the founding team. We need to feel like this is a group of people who can get it from zero to something that matters, right? So if we believe in those people, that collection of people, and then if we don't, we help that team attract the right talent to fill in any gaps. They might have a great leader and a great go-to-market specialist, but they're missing technical talent. We can help fill that gap, right? That's part of our role. So the team is the first step. What is our technical path and what is our technical moat is another one. Just what technology are we building that's going to give this one an outsized chance to win, but then also to scale very efficiently, right? That's sort of the second bucket for us. The third is some sort of go-to-market plan or asset that helps it move up the J curve faster. That might be in a consumer business, a celebrity partnership or a distribution partnership, et cetera, et cetera. In a B2B SaaS business, it might be a corporate partnership as well. It might be a Rolodex. It might be an individual who has sold in this space forever. Like, it could be lots of things, but something that's going to just mean potential customers are going to get eyeballs on this cheaper and more quickly than if we didn't have that asset in place. And so that's the third bucket. And then the last bucket, which is I think pretty self-explanatory, is just co-investment. Are other investors that we respect and know willing and able to write a check alongside of us? It might be that they're the exact same terms as us. It might be that they're 3 months later. But if we don't see that the market is validating what we're doing, we're going to pause for a second and say, why is it that people aren't going to write a check here, right? What is it that's missing from the story? And then it's probably in one of those three previous buckets, and we need to fill in those gaps, right? And so for us, going out to the market and getting co-investors is really important for validation of the concept, and also just having more folks around and their resources around those concepts as well.
It's interesting that you mentioned go to market because I feel like not a lot of people are. I'm not sure a lot of investors are really focused on go to market. I mean, I am just because of my background, but I don't feel like that a lot of people, like when they talk about it, that go to market is part of their kind of equation. So what does traction look like for you, and why do you kind of feel like it's important? I'm just honestly curious from someone else's perspective.
Yeah, I mean, the founders of M13, Carter and Courtney, were both previously entrepreneurs, right? And they saw what helped and what didn't help. And regardless of business model, of amount of investment, of market size, of anything, if you come out of the gates in the early days and you're just sort of hoping for people to pay attention, that's a tough strategy, right? The world is way too full of products, probably directly competitive with what you're building, to go out with sort of nothing to get people to pay attention, right? And so these guys come with a very unique point of view that I'd never really thought of before joining the firm. But it's like, hey, what assets can we bring that's going to get eyeballs on this quickly? Because if it takes us 2 years to get some set of eyeballs on this to do the learning that we could do in 3 months, we're toast.
Yeah.
Right. Someone else has passed us by. The moment has passed. The vertical is no longer hot. Like whatever it is, things change, and that's just too long to sort of wallow in your learning. And so the faster we get eyeballs, the faster we learn, the faster we can pivot, and the faster we can solve real problems for our customers. And so that has been a really important part of the Launchpad ethos for the last few years. Just before I joined, and to none of my credit, Launchpad launched Life Force, which is a health optimization and a hormone balancing platform in partnership with Tony Robbins. And Tony, as a speaker, as a face, and as a platform, helped that get a ton of eyeballs very quickly. And so that reaffirmed this concept of, hey, we should have something that helps this get out there more quickly. And sometimes that's just the founder. Literally, the founder came out of this space. So we have an AI video platform called Eon, AEON. The founder, Dan, has been in publishing for most of his career. He sold 2 companies into publishers prior to starting this business. And so Dan was the go-to-market. He just had the Rolodex. He had a bunch of people already lined up to try the product before it was even built. And so sometimes it's really an individual. Right now we're working on what I would call is a sleep optimization platform. And for that one, we're going to need to get in front of a whole bunch of consumers and doctors. And so we have really great credentialing on our team in terms of the science that we have, but that's not necessarily going to draw a ton of eyeballs. So now it's up to us to figure out who it is that comes in and fills that role. And so it's, of course, not every company that starts and gets big has something like that. But the key is really in today's hyper-competitive environment, where there's so many companies and so much funding, so many opportunities out there, it's sort of how do you separate yourself from the pack and get up the J curve a little bit quicker.
You make me feel a lot better about our own investment strategy, so thank you.
Honestly, I swear we didn't plan it, folks.
I mean, sometimes because the ethos in the Valley for so long was just keep raising money and you'll figure it out at the end. And I don't know, I have a contrarian view similar to that. And yeah, it makes me feel a whole lot better. So thank you.
A whole lot of, call it partnership in the beginning, and then a whole lot of product-led growth after that is going to go way further than just jamming cash down funnels, right? That doesn't mean there's anything wrong with spending marketing dollars. I absolutely believe in it. But if you can get those first 2 right, you get a multiplier on top of your dollars, right? And that just means everything goes further and more efficiently.
Yeah, I just, especially at the beginning, it's It's like you have to build and iterate really quickly, and those two things. I mean, that's the most important thing. If you can't do either one, then you're going to get tripped up somewhere. And so, yeah, I'd always felt that sales or some type of partnership in that something you're to your point, right? J curve to kind of set you apart and to be able to make those iterations has been super critical, and it's honestly what I push a lot of the founders now to be able to do when they come with something. It's like go test it out, like go put a payment card or something up to see if you can one test an actual product and see if it's actually there, and you will get real feedback then. Now I'm curious because you've been teaching at a university as well for a while now. Um, I like customer discovery in the standpoint of it. Yes, it's good to go talk to customers, but you run into challenges without getting any purchase intent out of it because people just want to be agreeable with you in general. Unless you force them to make a payment, you're not going to get necessarily that objection. What has been your kind of understanding, or what have you seen maybe through the evolution of it? Because I feel like customer discovery started with Steve Blank at the universities, and that was kind of the big kind of piece. And so I just want to see what your experience has been around that.
I think of customer discovery almost like what I said earlier around strong convictions loosely held. It's like listen really closely, but not too closely, right? Because the problem with customers is they don't know what they don't know. They don't know what they're missing. They don't know. They can't imagine that there's some other world that is dramatically different than what they've experienced so far, right? So if you say to somebody, back before Uber, like, wouldn't it be amazing if you pressed a button and a car showed up, right? Like, yeah, cool. That's all you get, right? You don't know like about pricing, or you have to just show them to them, let them use it and see what happens. And this is sort of the forced nature of iteration inside of startups. So we do this all the time inside of the studio. Is we take decks and Figmas and sort of cheaply build betas that aren't really products, and we put it in front of people. We say, what do you think? Right? But we sort of take it all with a bit of a grain of salt because we know that there's this massive gap in knowledge of, oh, the world hasn't moved to this place yet. So you don't even know that you need this yet. So we have to sort of put a little asterisk on the feedback. Or like you said, they don't actually have to pull out their wallet and make a purchase here. So it plays a role, but I would say that it's a directional role, right? You're not going to take the feedback literally. If they're like, no, I'll never need that, people don't know what they need in 6 to 12 months, right? They can't put themselves in that future state. And so you have to kind of read the tea leaves a little bit. So not doing it at all doesn't make a lot of sense. You want to listen to your customers, especially when you have real customers, to make the product better and iterate. But you don't want to take the feedback too literally, especially from a small set, just in a given period of time. There was a time when we launched Bouqs where people said, hey, we had three subscription offerings at the time. We had we called it regular blooms, which was once a month or once a week, like a regular subscription. We had one called special occasions, which would just show up on your birthdays and your anniversaries. And we had one called just because, which was just random delivery. You would say 5 times a year and it would surprise your girl with flowers 5 times a year, or your family member, whatever it was. Most people that signed up for the regular blooms one. It made the most sense because people are used to that model. But when I would describe the other two, that hey, you could just have every birthday in your life covered with flowers for the rest of your life, everyone would get super jazzed.
Yeah.
It would be like, no way, that's brilliant. Why isn't that's got to be everything, right? It was the tiniest sliver of revenue because people didn't know what it was. They couldn't understand in the context of buying flowers that this was a thing they should do.
Yeah.
So it was outside of their expectation of the product. And so they didn't sign up for it, even though when I would do a focus group, everyone would say, that's the thing I want. I just want that. And I'm like, well, you're the only one because millions of people have seen this product and no one signed up for it, right? So it's one of these things of, if I just took the customer feedback, if the customer discovered, I would have made that my whole business and we would have no business.
Just
to take sort of the data and the qualitative together.
No, I agree. Just to let you know, that is what I signed up for. Actually, the special occasions was that.
You're one of the few, man. We probably had like 10,000 total in a decade. But every time I go to a conference, that's how people learned about it. They signed up for that because I would talk about it. They'd be like, oh, yeah, that's the best. I want that.
I didn't have to think about it anymore.
That's right. It's just check the box,
Yeah, yeah,
done.
good. I'm done. I don't have to think about
Good.
it. I'm not going to screw this up. It's going to deliver.
That insight ultimately did inform the product that we have today. It's just we had to manifest it in a different way, which is now effectively an option within the subscription we offer on Bouqs. You can use it however you want to use it. You set it up for once a month, once every other week. This month it goes to my sister. This month to my mom. I'm going to skip this month. I'm going to let it come home for 2 weeks. Whatever it is, because really what people want is to not have to worry, and they don't have to want to have to shop. They don't want this because we have the best pricing. So once you're a subscriber, the pricing is locked in. But that's exactly my point. It's a great example of customer discovery. You kind of have to read the tea leaves and find what's the underlying motivation. What is the underlying reason here that I'm not quite hearing? And then put that together with your own vision. And honestly, sometimes you have to just be really right and just tell the customer they're wrong because they're the wrong customer or they don't have the context, whatever it might be. And sometimes you have to be really wrong. I set out with Bouqs, I was like, we're never going to sell vases. Vases make no sense. Everybody has 25 vases in their homes. They take up space. No one ever uses them. Why would I send a vase? And every day when we didn't sell vases, customers just said, please sell vases, please sell vases, please sell vases. And I was like, look, let's just turn on vases. No one's going to buy them. And it was all of a sudden like a 34, 39% take rate. It was the highest margin product we ever had. And it was like, all right, we're going to have vases.
Yeah, I mean, I would agree with your mentality because I remember when you didn't have vases and I would send it to my wife at work and she didn't have a vase there. And she's like, why are you not
A
sending it with
million
a
times.
vase?
But wait, I sent it to work. They open it, and now they're going home with it in like a plastic cup from the lunchroom. That's not a great experience, right? These are the things you learn as customers give you feedback. I was
Oh.
sure I was right on that. I was like, no vases ever. But customer feedback is sometimes right. Customer feedback is sometimes totally wrong. And like finding out when is really tough. And it really is a lot of the art on top of the science of customer discovery. I would say that there is genuinely not like a right approach.
All right, we're missing a hot take. Jamie, we're going to blame you and Ring on this one because who knew that when you ring a doorbell, it cuts off a lot of the things on your computer. So, John, I truly appreciate you coming to the show, and thanks again. Look forward to chatting again soon.